Chapter 10: Delivering Diversification with Packaged Securities. In this chapter, taking advantage of management investment companies, understanding face amount certificate companies and UTIs, reviewing REITs, looking at annuities, examining life insurance, reviewing investment company rules. Diversification is key when you're helping customers set up a portfolio of securities, and it's fairly easy when your customer has a good deal of money to invest. But what if an investor has limited resources? Great question. Certainly, such investors can't afford to buy several different securities, and you don't want to limit your customer to only one. Heavenly forbid it should go belly up. Package securities to the rescue. These securities, such as open-end funds, closed-end funds, face amount security certificate companies, UITs, real estate investment trusts, and annuities, offer variety within one security by investing a customer's money in a diversified pool of securities, for a cost, of course. A bit of profit-driven teamwork can ensure your customers' investments are much safer than, say, the blackjack tables of Vegas. In this chapter, we cover topics related to investment companies, REITs, and annuities, open-end mutual funds, and closed investment funds are only the beginning. We also discuss face amount certificate companies and trusts like unit investment trusts, or UITs. You'll notice, as with other chapters, that there is a bit of an overlap between the information you learn when taking the Security Industry Essentials exam and the information you'll see in this chapter. Diversifying through management investment companies. The Investment Company Act of 1940 divides investment companies into three main types: management investment companies, face amount certificate companies, and unit investment trusts. This section focuses on management investment companies, which the Series 7 tests more than the other types. Management investment companies are either open-end or closed-end funds. Management companies are by far the most familiar type of investment company. The securities held by management companies are actively managed by portfolio managers. Comparing open and closed-end funds. Management companies have to be either open-end or closed-end funds. Make sure you know the difference between the two. Open-end mutual funds. An open-end fund is more commonly known as a mutual fund. As with closed-end funds, mutual funds invest in many different securities to provide diversification for investors. The key difference is that mutual funds are consistently issuing and redeeming shares, which provides liquidity for investors. Because open-end fund shares are continuous offers of new shares, a mutual fund prospectus must always be available. You need to understand the makings of the net asset value and the public offering price when taking the Series 7 exam. Net asset value, fortunately, the net asset value or net asset value per share, NAV, is determined the same way for both open and closed-end funds, by dividing the value of the securities held by the fund by the number of shares outstanding. However, with open-end funds, the NAV is the bid price. When investors redeem shares of a mutual fund, they receive the NAV. Mutual funds can't ever trade below the NAV. Public offering price, POP. For mutual funds, the public offering price, the ask price, is the NAV plus a sales charge. If a mutual fund doesn't charge a sales charge, it's called a no-load fund. Because mutual funds are new issues, investors must receive a prospectus and or summary prospectus. Certainly, prospectuses for mutual funds include their holdings, investment strategy, fees, expenses, graphs of the fund's performance, etc. Every prospectus for every security must contain a disclosure stating that the SEC does not approve of this issue. We assume that this is the SEC's way of not being sued if investors lose money. The SEC just clears the issue. If the fund provides a summary prospectus, it must include items like the fund's name and ticker symbol, the class of shares, the fund's investment strategies, investment objectives, cost of investing, investment advisors, financial compensation, risk, performances, etc. The summary prospectus may include the application that investors can use to purchase shares. Potential investors can also request a full prospectus prior to investing. If an investor purchases via a summary prospectus, they must either receive or be provided online access to a full prospectus. On an ongoing basis, funds must include in the prospectus annual report graphs comparing the performance of the mutual fund to a proper index, S&P 500, NASDAQ Composite, etc. Items and or strategies that may have affected the performance in the past year and the name of the fund's manager. Note, expenses of a mutual fund include salaries for the board of directors, management, investment and advisor fees for the persons making the investment decisions for the fund, custodial fees for safeguarding of assets, cash, securities, etc. held by the fund, transfer agent fees for keeping track of investors, sending distributions, and sending proxies, and 12B1 fees if they have any. 12B1 fees are fees paid by a mutual fund out of the fund assets to cover promotional expenses such as advertising, printing, and mailing of the prospectuses to new investors, etc. If there are any 12B1 fees, they must be included in the prospectus. In addition to a prospectus, mutual fund investors may request a statement of additional information, SAI. The SAI provides more detail about the fund and its investment risk and investment policies. The SAI is not sent automatically. However, if requested, the SAI must be delivered within 3 business days. Closed-end funds. Unlike open-end funds, closed-end funds have a fixed number of shares outstanding, hence the word closed. Closed-end funds act more like stock than open-end funds because they issue new shares to the public, and after that the shares are bought and sold in the market. Because they trade in a market, they're often called publicly traded funds. Although the net asset value of closed-end and open-end funds is figured the same, the public offering price is determined a little differently. Net asset value. The net asset value, NAV, or net asset value per share, is the parity price where the fund should be trading. You determine it by taking all of the assets owned by the fund, subtracting the liabilities, and dividing it by the number of shares outstanding. Only closed-end funds may trade below the NAV at a discount. Public offering price, POP. For closed-end funds, the public offering price, the ask price, depends more on supply and demand than the NAV. Investors of closed-end funds pay the POP, current market price, plus a broker's commission. Although closed-end funds are not purchased from and redeemed with the issuer, they do offer a high degree of liquidity. After the initial offering, they can be purchased or sold either on an exchange or over the counter. Open and close. Focusing on the differences. You can expect at least a few of the Series 7 exam questions relating to investment companies to test you on the differences between open-end and closed-end funds. Forward pricing. Because open-end funds hold a basket of securities that are purchased from and redeemed by the issuer, there is no NAV. Any purchases or sales that take place during the trading day are held until the close of the market, until the next NAV can be completed. All redemptions of mutual fund shares are completed at the next completed NAV, the redemption price. The key difference between open-end and closed-end funds is the method of capitalization. An open-end mutual fund is a continuous offering of new securities, whereas a closed-end fund is a one-time offering of new securities. Comparing open-end and closed-end funds. Capitalization. Closed-end, one-time offering of securities at the IPO, initial public offering. Price, fixed number of shares outstanding. Open-end, continuous offering of new shares, no fixed number of shares outstanding. Pricing of fund. For close-in, investors purchase at the current market value, public offering price, plus a commission. And for open-end, investors purchase at the next computed net asset value, plus a sales charge. Issues. For close-in, common stock, preferred stock, and debt securities. For open-end, common stock only. Shares purchased. For closed-end, shares can be purchased in full only. For open-end, shares can be purchased in full or fractions, up to 3 decimal places. For purchases and sales. For closed-end, initial public offerings go through underwriters. After that, investors purchase and sell shares either over the counter or on an exchange. No redemption. For open-end, shares are sold and redeemed by the fund only. Exchange privileges. For closed-end, no exchange privileges. For open-end, shares may be exchanged or converted within the family of funds. For argument's sake, a customer may wish to exchange their Fidelity Mid-Cap Growth Fund for a Fidelity Intermediate Term Bond Fund. Withdrawal plans. For close-in, after the initial public offering, the securities are sold in the market, and therefore the issuer cannot set up a withdrawal plan for investors. For open-end, mutual funds allow systematic withdrawal plans, which allow investors to automatically receive a specific amount, which the fund from the fund each month as the issuer automatically redeems the shares necessary. Automatic reinvestment of dividends and capital gains. For close-in, this is not available for closed-end funds. For open-end, mutual funds allow investors to choose whether they wish to receive capital gains and dividends or to automatically reinvest the gains and dividends to purchase more shares. Systematic withdrawal plans. As an extra service, many mutual funds offer a systematic withdrawal plan as a way of redeeming shares. This type of plan is ideal for someone who's at the retirement age and looking for a little extra cash each month while still keeping a balance invested. Withdrawal plans can be set up as a fixed dollar amount periodically, a fixed share amount redeemed periodically, or a fixed amount of time. For example, redeeming the shares over a 10-year period. Not all mutual funds offer systematic withdrawal plans, but if they do, as a registered rep, you must disclose the risks involved to your client. Some of the risks include the client running out of money and no guaranteed rate of return. Regulated investment companies, RIC, regulated under Subchapter M. For an investment company to avoid being Taxed as a corporation, it must distribute or pass through at least 90% of their net investment income to shareholders. Net investment income is the amount received in dividends and interest less expenses. In the event that it distributes 90% or better, the investment company is only taxed on the amount of net investment income not distributed to investors. Diversified investment company. For an investment company to be considered diversified, it must meet the 75, 5, 10 test. The 75, 5, and 10 represent percentages. So for an investment company to claim it's diversified, no more than 5% of the 75% can be invested in one company. In addition, out of the 75% portion, the investment company cannot own more than 10% of the outstanding shares of any company. The remaining 25% can be invested in any way, and if an invested company doesn't meet the 75, 5, 10 test, it is considered non-diversified. Keeping your customers' investment objectives in mind. Unlike investors in the face amount certificate companies, unlike investors in the face amount certificate companies and unit investors, trust. Investors of open-end and closed-end funds have many choices available. Investors may be looking for safety, growth, a combination, and so on. Types of mutual funds. Mutual funds come in many types and flavors depending on your client's needs and tastes. Mutual funds can specialize in holding stocks, preferred stocks, short-term bonds, intermediate-term bonds, long-term bonds, or any combination of those. Here are some of the mutual funds. Money market fund. This fund, as you probably guessed, invests in money market instruments, short-term debt securities. You need to know the specifics of this fund, for there are more than this type of fund. Here are some key points. It usually provides a check writing feature. You're given a checkbook as a way of redeeming shares. It's always no load. There's no sales charge. It computes dividends daily and credits them monthly. And there's no penalty for early redemption. Equity and stock fund. The primary objective of an equity fund is to provide growth for investors. Equity funds invest primarily in stocks, but may hold a small amount of cash or cash investments. Equity funds can be further broken down by investment objectives such as growth, aggressive growth, value, international, and so on. Fixed income bond fund. Like an income fund, the objective of a fixed income fund is to provide current revenue to investors. The difference is that fixed income funds only invest in debt securities, not common stock or preferred stock. Investment fund. This type of investment company periodically offers to buy back a stated portion of fund shares from its shareholders. It is up to each shareholder whether they decide to accept the offer or to continue to hold the shares. Validity ratings and volatility ratings. There are companies that provide volatility ratings for bond mutual funds. The volatility ratings typically take into account the credit rating on the bonds held, sensitivity to the conditions in the general economy, the market price volatility of the portfolio, the fund's performance, interest rate risk, prepayment risk, currency risk, etc. If these volatility ratings are going to be used in retail communications, there are certain FINRA rules that must be followed. The volatility rating cannot be described as a risk rating. The ratings must be the most recent ones completed under the calendar quarter. The ratings must be clear, concise, and understandable and based exclusively on objective, quantifiable factors. The ratings must include the method used to determine the volatility, and a toll-free number and a website must be provided for the rating company. Fund objectives. The single most important consideration for customers who invest in packaged securities is the fund's investment objectives. This feature surpasses even the sales charge or management fees. As a registered rep, one of your primary jobs would be to help investors decide which type of fund would be best for them. The test designers want to know you can handle that job. Comparing like-type funds is secondary. I list funds based on their investment objectives as follows. Income fund. The primary objective of an income fund is to provide certain current revenue, not growth for investors. This type of fund invests most of its assets in a diversified portfolio of debt securities that pay interest and in preferred and common stock of companies that are known to pay consistent dividends in cash. Income funds are considered much safer, more conservative investments than growth funds. You can assume for the Series 7 exam and real-life purposes that income funds are better investment choices for retirees and investors who are looking for a steady cash flow without much risk. Balanced fund. A balanced fund is a combination of a growth fund and an income fund. Balanced funds invest in common stocks, preferred stocks, long-term bonds, and short-term bonds, aiming to provide both income and capital appreciation while minimizing risk. These funds don't get hammered too badly when the market is bearish, but usually underperform when the market is bullish. Growth fund. This fund is exactly what you would expect it to be. Growth funds invest most of their assets in a diversified portfolio of the common stock of relatively new companies, looking for big increases in stock prices. Growth funds offer a high potential for growth, but usually at a higher risk for the investor. This type of fund is ideal for an investor who's looking for long-term capital appreciation potential. Because of the inherent risk of investing in growth funds, they're better for younger investors who can take the risk because they have more time to recover their losses. Some growth funds are labeled as aggressive growth funds because the securities they invest in are even riskier than that of a standard growth fund. Value fund. A value fund invests in stocks that are considered undervalued based on fundamentals. The stocks purchased by this type of fund are ones that the fundamental analysts believe should be and will be trading at a higher price based on things such as the earnings of the company and comparisons to other companies. Specialized or sector fund. A specialized or sector fund is a type of fund that invests primarily in the securities of a single industry or geographical area. A specialized fund may invest only in financial securities, healthcare, automotive stocks, Japanese securities, etc. Because specialized funds are limited in their investments, you can assume that they're a little riskier, more volatile than the average fund. And here is fund of a fund. Many funds are actually funds of funds, which are known as multi-manager investments. These funds of funds don't purchase individual securities like other funds, but invest in a pool of other types of funds. As such, the management fees end up being higher for investors because the investor is not only paying the management fee for each individual fund, but also the management fee of the manager of the fund of funds. Fund of funds, or FOFs, typically purchase other mutual funds or hedge funds. This type of fund provides investors with both a chance to invest in funds that they may be out of the price range as well as the extreme amount of diversification to help lower risk and volatility. There are certainly many types of funds set up as funds of funds, including many life cycle funds and some hedge funds. And back to like funds. International or global funds. An international fund invests in companies based anywhere outside of the investor's home country. A global fund invests in securities located anywhere in the world, including the investor's home country. Although international and global funds may be good to round out a portfolio, they aren't without their risk. Along with the risk that investors face by just investing in securities in general, holders of international and global funds also face currency risk, which is the risk that the currency exchange rate between the U.S. and foreign issuers will hurt investors. There is also the additional risk that policies in a particular country will harm the value of the fund. Fund performance. Funds must disclose their average annual returns to help investors, representatives, investment advisors, etc., be able to compare like funds quickly. Securities laws require each fund to disclose the returns for 1, 5, and 10-year periods. If a fund hasn't been in existence for 10 years, it must disclose the returns since inception. The performance showing annual returns taking into account the load as well as being online is also disclosed in the fund's prospectus. Life cycle funds, understanding the basics. Life cycle funds are also called targeted date or age-based funds. The idea behind life cycle funds is to automatically adjust the composition of the fund so that investors take less risk as they get older. Typically, younger investors can afford to take more risk, therefore invest a larger percentage of their portfolio in equity securities and a lesser percentage in fixed income securities. As investors age, the percentages should change so that a larger percentage of the portfolio is fixed income securities and less percentage is in equity securities. Life cycle funds are set up with targeted retirement dates. Investors choose a life cycle fund that matches their retirement date, and the fund adjusts its fund holdings occasionally so that equity funds gradually decrease and funds that invest in fixed income securities gradually increase. Instead of purchasing and selling individual securities, life cycle funds may also be set up as funds of funds. Hedge funds, what are they? You've probably heard about hedge funds, but aren't exactly sure what they are. For the Series 7 exam, you need to know a little bit about them. Because they aren't open or closed funds, unit investment trusts, or face amount secured certificate companies, they are an exception to the standard definition of investment company under the Investment Company Act of 1940. In addition, because they are considered private investment companies sold privately under Regulation D and are only open to sophisticated, accredited investors, they are exempt from SEC registration. As such, many hedge funds have limited available information. Hedge funds often require a very high initial investment, sometimes $500,000 and more, therefore have limited or no liquidity. In addition, many have lockup provisions, which means that investors will not be able to redeem or sell shares during that time. Hedge funds hold a pool of investments and are professionally managed like mutual or open-end funds, but have a lot more flexibility. Hedge funds have a wide array of investment styles, models, and vehicles. Some are even blind pool, blind check investments. There is no stated goal. Hedge funds are typically much more aggressive in nature and may buy securities on margin, sell securities short, purchase or sell options, etc., in an attempt to maximize gains. I guess you can almost think of them as a whatever it takes to make money type of fund. The fees, costs, and expenses for investing in a hedge fund are typically around 2% per year for a management fee. In addition, many hedge funds charge as much as 20% of the profits made after a certain goal is reached. Taxation on hedge funds is similar to that of direct participation programs because they are set up as pass-through entities. So the fund itself is free of taxes and the gains and losses are passed through to the investors who are taxed at an individual level. Some hedge funds are set up as a fund of funds. So instead of an investor investing in one particular hedge fund, they are investing in a fund that pools many hedge funds together as a way of mitigating the risk of investing in one fund. The fees of investing in a fund of hedge funds are typically higher than investing in just a single hedge fund. In addition, there may be a longer lockup period. Don't let the variety of funds distract you too much. So many different funds are out there that the choices could drive you crazy. I list the main types, but funds can invest by objective or composition, such as with foreign stock funds, which invest in foreign securities, tax-exempt funds, which invest in municipal bonds, U.S. government bonds, etc. The composition of the fund should help you match it with your customer's objectives. For instance, a customer looking for safety and income may invest in a U.S. government bond fund. Dealing with discounts and methods of investment. Investors who have the extra funds available may be able to receive a reduced sales charge for large dollar purchases. Breakpoints and the letter of intent are available to investors of open-end funds and unit investment trusts. Because closed-end funds after the initial offering are traded on the market, investors do not receive breakpoints. Dollar cost averaging and fixed share averaging are most often used for open-end fund purchases, but may apply to other investments as well. Breakpoints. Funds have an investment advisor, portfolio manager, who gets paid a percentage of the value of the securities held in the fund. Therefore, one way to entice investors to spend more is to reduce the sales charge when they invest a certain minimum amount of money. That's where the break point comes in. Management investment companies divide purchase amounts into certain tiers within a certain range. Investors all pay the same sales charge percentage. But when investors invest enough to put them in the next tier, when they hit the break point, they get a reduced sales charge. Break points have no set schedule, so they vary from fund to fund. Here are a few points for you to remember for the Series 7 exam. Breakpoints must be disclosed in a prospectus. Breakpoints are not available to partnerships or investment clubs with several people pulling money together to receive reduced sales charges. Breakpoints are generally available to individual investors, joint accounts with family members, and corporations. Here's a hypothetical example of breakpoints for fictional ABC growth funds. For this fund, persons investing less than $10,000 would pay a sales charge of 5%. Persons investing between $10,000 and $19,999 would pay a sales charge of 4%. Persons investing between $20,000 and $39,999 would pay a sales charge of 4%. And a person's investing at least $40,000 would pay a 1.5% sales charge. Another discount, rights of accumulation, allows shareholders to receive a reduced sales charge, when the amount of funds held plus the amount purchased is enough to reach a breakpoint. So if the investor initially purchases $8,000 worth of ABC Growth Fund, they would pay a sales charge of 5%. Let's say that the market has been quite bullish, and the NAV of the shares purchased has increased $15,000, and they decide to purchase an additional $7,000 of the fund. Under the rights of accumulation, the sales charge on the $7,000 purchase would only be 3%, because adding the NAV of $15,000 and the purchase of $7,000 would bring the investment to more than $20,000. There is no time limit for rights of accumulation. Letters of intent. A letter of intent, LOI, signed by an investor, allows them to receive a breakpoint quantity discount right away with the initial purchase, even if the investor hasn't yet deposited enough money to achieve a breakpoint. This document states that as long as the investor deposited enough within a 13-month period, they will receive the discounted sales charge right away. Here are a few specifics about the letter of intent that you need to know for the Series 7. The investor has 13 months after the first deposit to live up to the terms of the letter of intent in order to maintain the reduced sales charge. The LOI may be backdated for up to 90 days, meaning that it may apply to a previous purchase. However, remember that if the LOI applies to a previous purchase, the 13-month period starts from the date of that purchase transaction. While the investor is under the letter of intent, shares are held in escrow to pay for the difference of the sale charge. If the investor doesn't live up to the terms of the obligation, the fund sells the shares held in escrow. Here's how a letter of intent may work. Suppose, for instance, that Mr. Smith purchased $2,000 worth of ABC Growth Fund 2 months ago and has another $7,000 to invest in the fund right now. Mr. Mr. Smith believes that he'll keep investing in ABC Growth Fund and would like to get a reduced sales charge for investments of $10,000 and up. Mr. Smith signs a letter of intent and wants to apply it to his previous purchase. Because his previous purchase was 2 months ago, Mr. Smith has only another 11 months to invest the remaining $8,000 into the ABC Growth Fund. Mr. Smith will receive the 4% sales charge on his $7,000 investment right now, which will be reduced by the percentage he paid on the previous investment of $2,000. In other words, he'll pay only $260 sales charge on the current investment, $280 for this transaction minus the $20 overpaid from the previous investment when he invested $7,000. As long as Mr. Smith deposits the additional $1,000 by the end of the letter of intent's time frame, he'll pay the 4% sales charge. However, if Mr. Smith doesn't live up to the terms of the agreement, ABC Growth Fund will sell the shares held in escrow to pay for the difference in the sales charge. Investors may redeem their shares at any time, even if they're under a letter of intent. Dollar cost averaging. If an investor is employing the dollar cost averaging formula, they are investing the same dollar amount into the same investment periodically. Although dollar cost averaging is primarily used for mutual funds, people can use it for other investments as well. Dollar cost averaging benefits the investor when the price of the security is fluctuating. The investor ends up buying more shares when the price is low and fewer shares when the price is high by depositing the same amount of money each time they make a purchase. And dollar cost averaging results in the average cost per share that is lower than the average price per share if the price of the fund fluctuates. The following question tests your understanding of dollar cost averaging. Mrs. Johnson deposits $1,000 into Deaf Growth Fund in 4 separate months. The purchase price of the fund are as follows. 1 month, month 1, $40. Month 2, $50. Month 3, $50. Month 4, $40. What is the average cost per share for Mrs. Johnson? A, $40. B, $44.40. C, $45. Or D, $48.35. The correct answer is choice B. On the surface, this question may look very easy to you. You may jump to choice C. But choice C is the average price per share, not the average cost. Remember that because Mrs. Johnson is investing the same amount of money each month, she's able to buy more shares when the price is low and less when the price is high. In the first and fourth months, when the price is $40 per share, she was only able to buy 25 shares each time. In the second and third months, she was able to buy only 20 shares each time. Over the 4 months, Mrs. Johnson invested a total of $4,000 and purchased a total of 90 shares. The average cost per share is $44.44. If you use your sense of logic and watch for ways to eliminate answer choices, you may get away with doing very little math. Here you can answer the question by finding the average cost per share, which is not what the question is looking for. With dollar cost averaging, buying more when the price is low drives the average cost down. Therefore, the average cost per share has to be between minimum price per share and the average price per share, $40 and $45 respectively. The only number that fits these criteria is $44.44 with choice B. You should be prepared to calculate the average cost per share, the average price per share, $45, and the amount saved per share, 50 cents. Figure in the sales charge and public offering price of open-end funds. You need to know 2 basic formulas to determine the sales charge and public offering price of open-end funds. Yes, every chapter seems to have more formulas, but these formulas are pretty straightforward and shouldn't cause you too many sleepless nights. Sales charge percent. The sales charge, which is set at a maximum of 8.5%, is part of the public offering price or as price, not something tacked on afterward like a sales tax. One of the tricks for calculating the sales charge for open-end funds is remembering that the POP equals 100%. Therefore, if the sales charge is 8%, the net asset value, NAV, is 90% of the POP. The formula for determining the sales charge percent is as follows. Sales charge percent equals ask minus bid divided by ask, which equals POP minus NAV divided by POP. The following question tests your knowledge and expertise in calculating the sales charge of a mutual fund. LDEC Aggressive Growth Fund has a net asset value of $90.20 and a public offering price of $10. What is the sales charge percent? A, 6.8%, B, 7.5%, C, 8%, or D, 8.7%. The right choice is C, first thing you want to do is set up the equation. Start with the POP of $10 and subtract the NAV of $9.20 to get 80 cents. Next, divide the 80 cents by the POP of $10 to get the sales charge of 8%. To help you remember that the ask offer price of a fund is the same as the POP, remember to ask your pop about it. POP. Public offering price. When taking the Sales 7 exam, you may be asked to figure out the public offering price of a mutual fund when you're given only the sales charge percent in the NAV. Remember that the sales charge is already a part of the POP, so the sales charge is not equal to the sales charge percent times the NAV. Use the following formula to figure out how much an investor has to pay to buy shares of the fund when you know only the NAV and the sales charge percent. Public offering price equals net asset value divided by 100% minus sales charge percent. The following question tests your ability to answer a POP question. Deaf Aggressive Growth Fund has an NAV of $9.12 and a POP of $9.91. If there is a 5% sales charge for the investments of $30,000 and up, how many shares can an investor who is depositing $50,000 purchase? A. 5,045.409 shares. B. 5,208.33 shares. C. 5,219.207 shares. Or D. 5,482.456 shares. The answer that you want is choice B. Don't let the decimals throw you off. Mutual funds can sell fractional shares. This investor isn't going to be paying the POP of $9.91 per share because they're receiving a break point for a larger dollar purchase. To figure out the POP for this investor, set up the formula. POP equals NAV divided by 100% minus sales share percent. The sales charge percent, which equals $9.12 divided by 100% minus 5%, which equals $9.12, 12 cents divided by 95%, which equals $9.60 per share. After working out the formula, you can see that the investor is paying $9.60 per share instead of $9.91. Next, determine the number of shares the investor can purchase by dividing the amount of the investment by the cost per share. $50,000 divided by $9.60 per share, which equals 5,208.333 shares. The investor is able to purchase 5,208.333 shares because of the breakpoint. However, without the breakpoint, the investor would have been able to purchase only 5,045.409 shares. Loads. As I explained earlier in this chapter, most mutual funds charge a sales charge, also known as a load, that's built into the public offering price. However, most charge upfront. Sometimes some charge constantly, some charge when redeeming, and some don't charge a load at all. Depending on how investors are charged, mutual funds are broken down into classes. Class A, front-end load. The investor pays the load when purchasing shares of the fund. Quite often, Class A shares will impose a sales charge based on the assets held. The asset-based class charge is often around 0.25% per year. However, Class B and C shares often charge closer to 1% per year. Note, asset-based sales charges are not paid by investors directly but are taken out of the assets held by the fund to compensate brokers, pay for advertisement, pay for prospectuses, 12B-1 fees, etc. Class B, back-end load. In addition to having higher asset-based sales charges than Class A shares, investors pay a load when redeeming shares of the fund, which is known as a contingent deferred sales charge, CDSC. The CDSC is usually not charged if the investor holds the shares for enough years, typically around 6. Typically, in about 2 years after the CDC is eliminated, the Class B shares are converted into Class A shares, and the yearly asset-based sales charge is lowered accordingly. Class C, level load. Investors do not pay a front-end sales charge but pay an annual asset-based sales charge similar to what Class B shares pay for the first several years. The difference is that Class C shares do not convert into Class A shares, so the annual asset-based sales charge remains at the same high level no matter how long the shares are held. If shares are held for a long period of time, Class C shares end up costing investors more. Class D no load. Investors don't pay a sales charge but may be charged some sort of transaction fee. Class D shares are not typically available to all investors. Class D shares are only available to certain retirement plans and brokerage firms. Expense ratio. Something else that investors should be concerned about is a fund's expense ratio. To determine the fund's expense ratio, you have to divide the fund's expenses, management fees, and operating fees by the fund's average net assets. So if the expense ratio of a fund is 2%, that means that the fund is charging $2 for every $100 invested. The higher the expense ratio, the more the fund is eating into your pockets. You can definitely expect a question or two relating to taxes on mutual funds. Considering other investment company options. A couple of other investment companies and their types: face amount certificate companies and unit investment trusts aren't as popular as they used to be. Unfortunately, even though you may never sell any, you do need to know them for the Series 7 exam. You probably won't see them on one or two questions on the topics. However, ETFs or exchange traded funds are becoming increasingly popular, and your chance of having a question on ETFs or inverse ETFs is around 100%. Face amount certificate companies. A face amount certificate is a type of packaged security that's similar to a zero coupon bond. Investors make either a lump sum payment or periodic payments in return for a larger future payment. The issuer of a face amount certificate guarantees payment of the face amount, a fixed sum, to the investor at a preset date. Very few face amount certificate companies are around today. Unit Investment Trust. A unit investment trust, UIT, is a registered investment company that purchases a fixed, unmanaged portfolio of income-producing securities, typically bonds, and holds them in trust, which means that a UIT is acting as a holding company for its investors. Then the company issues redeemable shares or units that represent investors' interests in the trust. Unlike mutual funds, UITs are set up for a specific period of time and set at a termination date. Any capital gains, interest, and/or dividends are passed on to shareholders at regular intervals. UITs have a finite number of shares outstanding and are distributed in the primary market at the IPO price. Because a limited number of shares are outstanding and they must be redeemed with the issuer or sponsor, liquidity is very limited. Like mutual or open-end bond funds, UITs can be purchased by types such as growth, income, balance, international, etc. Here are the two main categories in these trusts: Fixed investment trusts. These companies invest in a portfolio of debt securities, and the trust terminates when all the bonds in the portfolio mature. Participating trusts. These companies invest in shares of mutual funds. The mutual funds that the trust holds don't change, but the securities held by the underlying mutual funds do. Because the portfolio of security is fixed, UITs don't employ investment advisors and therefore have no investment advisor fees during the life of the trust. Exchange traded funds, ETFs. ETFs are closed-end index funds that are traded on an exchange. ETFs provide investors with diversification along with ease of trading, the ability to sell short, and purchase shares on margin. Inverse ETFs, also known as short ETFs or bear ETFs, are exchange-traded ETFs that are designed using many derivative products such as options to attempt to profit from a decline in the value of underlying securities, for example, the S&P 500. Inverse ETFs can be used to purchase. Inverse ETFs can be used to profit from a decline in a broad market index or in a specific sector such as the energy or financial sectors. When compared to mutual funds, ETFs have some distinct advantages, including the ability to purchase shares on margin, ease of trading, and lower operating costs. There are a couple of disadvantages when comparing ETFs to mutual funds. Investors are charged commissions when buying and selling because they are easy to trade. Investors are more likely to trade excessively instead of holding their positions. Reducing real estate risk with REITs. Real estate investment trusts, REITs or REITs, is a trust that invests in real estate related projects such as properties, mortgage loans, and construction loans. REITs pool the capital of many investors to manage property and or purchase mortgage loans. As with other trusts, they issue shares to investors representing their interest in the trust. REITs may be listed on an exchange or can trade over the counter. They also provide real estate diversification and liquidity for investors. REITs are distributed in the primary market at the IPO price. Unlike mutual funds, which are redeemed with the issuer, REITs are traded, bought and sold in the secondary market to other investors. In addition, REITs have a finite number in shares outstanding, like closed-end funds. Because REITs are traded in a secondary market, their price may be at a discount or premium to the NAV, depending on investor sentiment. Equity REITs take equity positions in real estate properties. The income is derived from rent collected or profits made when the properties are sold. Mortgage REITs purchase construction loans and mortgages. The trust receives the interest paid on the loan and in return passes it on to the owners of the trust, the investors. Hybrid REITs are a combination of equity and mortgage REITs. Hybrid REITs generate income derived from rent and capital gains, like an equity REIT, and interest, like a mortgage REIT. REITs can avoid being taxed like a corporation if at least 75% of income comes from real estate related activities. At least 75% of the REIT's assets are in real estate, government securities, and or cash. And at least 90% of the net income received is distributed to shareholders who pay taxes on the income. You don't get REITs confused with real estate limited partnerships. Limited partnerships pass on income and write-offs to investors to claim on their personal income tax return. REITs pass only income through to investors. Don't kill yourself worrying too much about REITs. Not that you would. You don't give more than 1 or 2 questions on the Series 7 exam relating to REITs. REITs typically offer investors stable dividends based on the income from the REITs. Unlike other equity securities, dividends received from REITs are not qualified, meaning that the tax rate due cannot be reduced based on the holding period and the investor's tax bracket. However, dividends from REITs do receive a special tax benefit, which is 20% of the income distributed to be deductible or tax-free. If the REIT distributes income based on the sale of the property, it will pass through either short or long-term capital gains to the investor based on the holding period of the property sold. If investors decide to sell their REITs, they may have a gain or less loss depending on their cost basis and the selling price. In addition, a gain or loss may be long or short term depending on the investor's holding period. Dividends declared by REITs in the fourth quarter, October, November, and December, made payable to shareholders up through January of the following year, shall be redeemed to have been received by shareholders during the year it was declared. Adding annuities to a portfolio. Annuities are similar to mutual funds, except annuities are designed to provide supplemental retirement income for investors. Life insurance companies issue annuities. And these investments provide guaranteed payments for the life of the holder. The Series 7 exam tests you on the two basic types of annuities, fixed and variable. Because variable annuities are considered securities and fixed annuities are not, because of the guaranteed payout by the insurance company, most of the annuity questions on the Series 7 exam are about variable annuities. Gather very specific information about your client before making recommendations. Annuities have been under the watchful eye of state insurance commissions and the SEC due to inappropriate recommendations from some brokers. Annuities typically aren't recommended for younger clients. Most annuity purchasers are over the age of 50. For clients older than 75 or for a client's entire portfolio. Looking at fixed annuities. The main thing for you to remember about fixed annuities is that they have fixed rates of return that the issuer guarantees. Investors pay money into fixed annuities and the money is deposited into the insurance company's general account. After the investor starts receiving payments from the fixed annuity, usually monthly, the payments remain the same for the remainder of the investor's life. Because of the guaranteed payout, fixed annuities are not considered securities and therefore are exempt from SEC regulation requirements under the Investment Act of 1940. Because the payouts associated with the fixed annuity remain the same, they're subject to the purchasing power risk, the risk that the investment won't keep up with inflation. An investor who received payments of $1,000 per month in the 70s may have been able to survive. However, that amount today is not even likely to pay your monthly grocery bill. Checking out variable annuities. Insurance companies introduce variable annuities as a way to keep pace with or hopefully exceed inflation. In a fixed annuity, the insurance company bears the inflation risk. However, in a variable annuity, the investment risk is borne by the investor. Because the investors assume the investment risk, variable annuities are considered securities and must be registered with the SEC. All variable annuities have to be sold with the prospectus, and only individuals who hold appropriate securities and insurance licenses can sell them. It will be your job as a registered representative to make sure that variable annuities are right for your clients prior to recommending them. You should have a reasonable basis to believe that your client would benefit from adding variable annuities to their portfolio. To do so, you should analyze whether the client would benefit from the tax deferral annuitization, living and or death benefits provided by variable annuities. Separate account. The money that investors deposit is held in a professionally managed separate account, separate from the insurance company's other business, because the money is invested differently. The separate account is invested in securities such as common stock, bonds, mutual funds, etc., with the hope that investments will keep pace with or exceed the inflation rate. Separate accounts must be registered with the SEC as investment companies. Income and capital gains generated are accredited to the separate account. Also, if the investments in the separate account lose money, it is charged to the separate account. The separate account is unaffected by the insurance company's other business. Assumed interest rate. The assumed interest rate is a projection of the performance of the securities in a separate account over the life of the variable annuity contract. If the assumed interest rate is 4% and the performance of the securities in the separate account is equal to 4%, the investor receives the payouts that they expect. However, if the securities outperform the AIR, or assumed interest rate, the investor receives higher payouts than expected. And unfortunately, if the securities held in a separate account underperform the AIR, the investor gets lower payouts than expected. Putting money into and receiving money from annuities. Investors have choices when purchasing annuities and getting distributions. During the accumulation phase, investors will decide how to allocate their investment options. For example, investors may decide to put 30% into a particular bond fund, 50% into a U.S. stock fund, and 20% into an international stock fund. Investors may also choose a lump sum payment on multiple payments depending on their needs. Investors also have a choice regarding how they want to get their distributions at retirement. Fees. Insurance companies aren't setting up annuities for investors just because they like to help people out, and they receive money for doing so, even though the initial sales lows might be minimal or non-existent for investors purchasing annuities. They will get charged pretty heavy sales charges, surrender charges, if they close out the annuity early. The insurance company makes additional money on management fees and other expenses. Some additional charges that investors should be aware of, depending on the variable annuity offered, could be charges for stepped-up benefits, guaranteed minimum income benefits, and long-term care insurance. If the applicable charges would be found in the variable annuity prospectus. Looking at the pay-in phase. Payments into the fixed and variable annuities are made from after-tax dollars, meaning that the investor can't write the payments off in their taxes. However, payments into both fixed and variable annuities grow on a tax-deferred basis. They aren't taxed until the money is withdrawn. If an investor has contributed $80,000 into a variable annuity that's now worth $120,000, the investor is only taxed on the $40,000 difference because they have already paid taxes on the contribution. If an annuitant dies during the pay-in phase, most annuity contracts require a death benefit to be paid to the annuitant's beneficiary. The death benefit is typically the greater of all the money in the account or some guaranteed minimum. During the pay-in phase, an investor of a variable annuity purchases accumulation units. These units are similar to shares of a mutual fund. Investors have a few payout options to select when purchasing fixed or variable annuities. Here's a rundown of options. Single payment deferred annuity. An investor purchases the annuity with a lump sum payment, and the payments are delayed until some predetermined date. Periodic payment deferred annuity. An investor makes periodic payments, usually monthly, into the annuity, and the payments are delayed until some predetermined date. This is the most common type of annuity. Immediate annuity. An investor purchases the annuity with a large sum, and the payouts begin within a couple of months. Most annuities in which investors are making scheduled deposits provide a waiver of premium during the pay-in phase if the annuitant becomes disabled or is confined to long-term care. Getting the payout. Investors of both fixed and variable annuities have several payout options. These options may cover just the annuitant investor or the annuitant and a survivor. No matter what type of payout option the investor chooses, they will be taxed on the amount above the contribution. The earnings grow on a tax-deferred basis, and the investor is not taxed on the earnings until withdrawal at retirement. During the payout phase of a variable annuity, accumulation units are converted into a fixed number of annuity or annuitization units. Investors receive a fixed number of annuity units periodically, usually monthly, with a variable value depending on the performance of the securities in the separate account. When an investor purchases an annuity, they have to decide which of the following payout options works best for them. Like a life annuity. This type of payment option provides income for the life of the annuitant, the individual covered by the annuity. However, after the annuitant dies, the insurance company stops making payments. This type of annuity is riskiest for the investor because if the annuitant dies earlier than expected, the insurance company gets to keep the leftover annuity money. Because it's the riskiest type of annuity for the annuitant, it has the highest payouts of all the options. Life annuity with period certain. This payout option guarantees payment to the annuitant for a minimum number of years, 10, 20, etc. For example, if the annuitant were to purchase an annuity within a 20-year guarantee and die after 7 years, a named beneficiary would receive the payments for the remaining 13 years. joint life with last survivor annuity. And this option guarantees payments over the lives of two individuals. As you can imagine, this type of annuity is typically set up for a husband and wife. If the wife dies first, the husband receives payments until his death. If the husband dies first, then she gets the payments. Because this type of annuity covers the lifespans of two individuals, it has the lowest payouts. All annuities have a mortality guarantee. This guarantee means that an investor receives payments as long as they live, even if it is beyond their life expectancy. This is a risk for the insurance company, so it typically charges each account around 1.25% per year to cover that risk. Early withdrawal penalty. As with other retirement plans, annuity investors are hit with a 10% early withdrawal penalty if they withdraw the money prior to age 59 and a half. Yes, that's correct. The 10% penalty is added to the investor's tax bracket. Typically, retirement plans include a waiver of the 10% penalty in cases such as the purchase of a first home, age 55, and separated from work, death, or disability. Death benefit. If the annuity holder dies before the issuer has started making payments, the beneficiary is guaranteed to receive a specified amount. That specified amount is typically at least the amount that was paid into the annuity, even if the account value is less than the guaranteed amount. However, that amount could be lowered if withdrawals have been made from the account. The death benefit is a common option. Investors should understand that additional benefits cost additional money. Surrender value. The surrender value, or cash surrender value of an annuity, comes into play when an annuity is voluntarily terminated, cashed in before its maturity. In that case, the annuity holder will receive the cash value less surrender fees. Quite often, the cash surrender value will be less than what the annuity holder has paid in premiums. Typically, the surrender fees, which are a percentage of the cash value, decrease the longer the policy is kept in force. Investors are usually better off maximizing their investment values, vehicles, such as IRAs and 401ks prior to investing in variable annuities. Exploring variable life and variable universal life insurance. You may wonder what life insurance is doing on the Series 7, which is mainly about investments. Well, the answer is that unlike term insurance, certain life insurance products, specifically variable life, VLI, and variable universal life, VUL, have an investment component. Like variable annuities, variable life, and variable universal life insurance policies have a separate account for investing. That separate account is kept separate from insurance company's general fund. You won't need to know too much about the aforementioned insurance products, so we'll keep it brief. Persons selling variable annuities, variable life insurance, and variable universal life insurance must have not only an appropriate securities license but also an insurance license. And prior to recommending any of the previously mentioned products, you should do an analysis of the client's needs and make appropriate recommendations. Variable life. Variable life policies have a fixed premium. As with variable annuities, the investor chooses the investments held in a separate account. The death benefit face amount on the policy is fixed to a minimum but not to a maximum. Funds covering the minimum death benefit are kept in the insurance company's general fund. The death benefit may increase depending on the performance of the securities held in a separate account. If the separate account performs poorly, there may be limited or no cash value built up. Policyholders may borrow up to 75% of the cash value. Variable universal life. Unlike variable life policies, variable universal life policies do not have fixed premiums. As such, they are sometimes called flexible premium variable life policies. As with variable life policies, the investors can pick the securities held in a separate account. In this case, since the premium is not fixed and the securities held in the separate account may perform poorly, the minimum death benefit and the cash value are not guaranteed. Part of your job is to clearly define what the specific securities are to investors. FINRA has specific guidelines relating to the description of variable life insurance and variable annuities. The following bulleted list focuses on those guidelines. You must make sure that your customers clearly understand the difference between variable annuities and variable life insurance and which one you're recommending. You must not imply that the variable life insurance or variable annuity is not a mutual fund. You must make sure that the customers understand that they are not liquid investments and they are severe tax and or early redemption penalties. Also, with variable life insurance, you must discuss loans and withdrawals and how they would affect the cash value and death benefits. Variable life insurance policies and variable annuities provide holders with certain guarantees, which should not be overemphasized. There should be no representation or implication of a guarantee about the return or principal or investment return of the separate account. You may show historical data of how a fund would have performed had it been an investment option and a variable annuity or variable life insurance policy. However, that information may only be used if there was no significant change to the fund during the period being shown or discussed. You may also compare investment choices and rankings. For variable life insurance communications, you may use a hypothetical assumed interest rate to demonstrate how the policy operates and how it will affect the cash value and death benefit. However, your customer must clearly understand that it is hypothetical and not a prediction of investment results. Because variable life policies have an investment component, the separate account, investors must receive a prospectus at or before the time of solicitation. (1035) Tax-free exchange. Investors may find that it is advantageous for them to switch life insurance policies or annuities. Under Section 1035 of the Internal Revenue Code, individuals may exchange an insurance policy for another insurance policy or annuity insuring the same person without having to pay taxes on the income and investment gains in the original contract. Investors are also allowed to switch from an existing variable annuity contract to another. However, investors cannot switch from an annuity to life insurance policy without having to pay taxes. Investment company rules. Besides all the other investment company stuff you need to know prior to taking the Series 7, there are some additional investment company rules you'll need to touch base with. I've done my best to cover most of the prior rules in this section, but alas, there are more. I condensed the rules to just the most important info for your listening pleasure. Investment company sales literature. It's illegal for any person to use misleading sales literature, whether written or electronic, in connection with the offer or sale of investment company securities. Sales literature is considered misleading if it contains a statement of material fact which is untrue, or it omits a statement of material fact which would be necessary to make a statement not misleading. Advertisements by an investment company, Section 10. Under Section 10, the following information must be included with investment companies' advertisements. A statement that investors should consider the risk, investment objectives, charges, and expenses carefully before investing. A statement that investors can find additional information about the investment company in the prospectus and summary prospectus if available. It must identify how investors can obtain a prospectus and summary prospectus if available, and that the prospectus and summary prospectus, if available, should be read thoroughly before investing. Advertisements used prior to the effectiveness of the investment company's registration statement or the determination of the public offering price must include a subject to completion legend. Advertisements related to open-end investment companies that include performance data must include a statement that you probably heard a variation of hundreds of times before. It goes something like this: past performance does not guarantee future results, or people can and do lose money, and so on. It must also disclose that investment return and principal value will fluctuate. So when an investor redeems their shares, they may be worth more or less than the original cost, and the current performance may be higher or lower than the performance data quoted. The ledger should also include a toll-free number or web address where investors can obtain the most recent performance data. In addition, if any non-recurring fee, such as a sales load, is charged, the maximum load or fee must be reflected. Investment company rankings and retail communication. Under FINRA rules, members may only use investment company rankings and retail communications if the rankings were created and published by a ranking entity. Any independent of the investment company and its affiliates that provides general information about investment companies to the public and whose services are not procured by the investment company or its affiliates, to assign the investment company a ranking, or created by an investment company or investment company affiliate that were based off the performance measurements of a ranking entity. If ranking data is to be used in retail communications, there must not be a statement that implies that an investment company or investment company family is the best performer in a category unless it is top ranked. In addition, the communication with the ranking information must include the name of the category, growth, balance, international, etc. The number of investment companies in the category, the name of the ranking company, the length of the period for the ranking, criteria on which the ranking is based, and the normal disclosures such as past performance is no guarantee of future results. Even more rules. The following rules are taken from the Investment Company Act of 1940. Section 10. The board of directors in an investment company must be made up of no more than 60% insiders, those who have affiliation with the company that issued the fund. Having this role allows investors to gain some representation on the board of directors through voting. Although up to 60% is the rule, many investment companies have a board of directors that is made up of around 25% insiders. Section 10A. Registered investment companies may not, 1, purchase securities on margin except as deemed necessary for the clearance of transactions, or 2. Purchase in a joint trading account in securities unless in connection of an underwriting or securities in which the registered investment company is a participant, or 3. Sell securities short except in connection with the underwriting of securities in which the registered investment company is a participant. Section 3A. Unless voted on by a majority of its outstanding voted securities, registered investment companies may not 1. Change its title or subclassification from a diversified to a non-diversified company, or 2. Issue senior securities, borrow money, underwrite securities issued by other companies, buy or sell real estate, buy or sell commodities, or make loans to other persons unless such provisions are contained in the registration statement, or 3. Deviate from its investment policy with regards to concentration of investments. Deviate from any policy in its registration statement or change its business in a way so it ceases to be an investment company. Section 15A. A person may not serve as an investment advisor of a registered investment company unless there's a written contract with the investment company and the investment advisor has been approved by a vote of a majority of the outstanding voting securities. The contract must 1. Describe how the investment advisor is to be paid, and 2. Remain in effect for a period of time more than 2 years from the date of execution, with at least an annual approval from the majority of the outstanding voted securities and the board of directors. 3. Provide for the termination of the investment advisor contract without penalty with a vote of a majority of outstanding voted securities and the board of directors. And 4. Provide for an automatic termination in the event of its assignment. Section 16A. Persons holding a seat on the board of directors of a registered investment company must be voted into office by the holders of the outstanding voted securities of the company at an annual or special meeting called for that purpose. In the event a vacancy occurs in between voting meetings, the seat may be filled at least temporarily by a vote of at least 2/3 of the board of directors who have been voted into office. Section 19. Dividends paid out by a registered investment company must 1. Come from an undistributed net income from profits or losses realized on the sale of the securities or other properties. 2. From other source, as long as the dividend payment is accompanied by a written statement adequately disclosing the source of the payment. In addition, registered investment companies may not distribute long-term, over 1 year capital gains more than once every 12 months. Section 30. Registered investment companies must file annual reports with the SEC In addition, registered investment companies must transmit to their stockholders at least semi-annually balance sheets, income statements, etc. Section 35. It is unlawful for any person issuing or selling registered investment company securities to represent or imply that the security or investment company, 1, has been sponsored, recommended, or guaranteed by the United States or any of its agencies, or 2, has been insured by the Federal Deposit Insurance Corporation, FDIC, or is guaranteed by its obligation of any bank or issued insured, or 2, has been insured by the FDIC, Federal Deposit Insurance Corporation, or is guaranteed by or is an obligation of any bank or insured depository institution. If the securities are sold through a bank, the bank shall prominently disclose that it is not FDIC insured or insured by any other government agency. Section 36. The SEC has the authority to bring action against persons acting as 1, an officer, director, member of an advisory board, investment banker, advisor, or depositor, or 2, a principal underwriter for a registered open-end investment company, unit investment trust, or face amount certificate company. The SEC may bring action if, within the last 5 years, the person has engaged in the act or is about to engage in the act, breaching fiduciary duty involving personal misconduct. Section 37. Persons convicted of stealing, unlawfully abstracting, unlawfully and unwillfully converting to his own use or the use of another, or embezzles monies, funds, securities, credits, property, or any other asset of an investment company shall be subject to the penalties provided under Section 49 of the Investment Company Act of 1940. Maximum $10,000 fine and or 5 years of imprisonment.